Chapter 21, this is part 3, and now I'm going to go through the whole cash flow statement, including the direct and indirect method for operations, and then I'll do investing and financing activities. So again, it's all about that presentation. What we have to do is look at our cash flow based on where the money came from. Did it come from operations? Did it come from investing? And again, for operating, we've got the direct and indirect method. Or did it come from financing activities? Now, when a company starts out, they get most of their cash from financing activities by issuing stock. But the goal is hopefully to get most of their cash through operating activities. And when a company is having trouble, a lot of times they have to sell off their assets, so you'll see a lot of cash flow from investing activities. So now we're going to walk through an example to do the whole cash flow statement. So here's our example. First, we need again a balance sheet for 2 years, and the first thing what we want to do is we want to take a look at what are the changes in the accounts. So that's what I always like to do, and I want to see, did they go up or did they go down? Next, I also need the income statement, and along with that, I also need additional information about transactions that affect investing and financing activity, and that explain the changes in those accounts, i.e., long-term assets and long-term liability and equity accounts. Now we can start our process, and we're going to start with doing operating activities, the direct method. So we have our format, and we're going to always start with cash received. The next thing we have to look at are the cash payments. And here are some examples of the accounts. What we want to do is look at these accounts and then adjust for changes. For example, in the case of suppliers, we need to look at changes in inventory and accounts payable. Then we're going to look at salaries adjusted for changes in any liabilities associated with that, as well as interest and income tax. And that's going to give us net cash provided by operating activities. Now, the next thing we're going to do is we're going to look at the balance sheet, and we've done the changes. So step 1, what we're going to do is, what is the change in the cash? Because in the end, that is what we have to explain. When we total up operating, investing, and finance activities, it must equal a positive 12 because our cash went up by 12. So what we're going to do is we're going to explain what caused that increase of 12. So in order for us to do that, we need to go through all our balance sheet accounts and identify them as operating, investing, or financing activities, which we've done here. Now, remember that retained earnings is part of operations as well as finance because it's got income and dividends. Now what we're going to do is we're going to go through and look at those that associated with operations. So we've got accounts receivable. We need to look at that change because that's going to affect our sales, our cash from sales. We're going to look at inventory. We will not look at depreciation because we only look at that when we do the indirect method. We're also going to look at accounts payable because that will affect the cash we receive from suppliers, salaries payable, interest payable, and income tax payable. So those are going to be the items we have to look at when we do that cash flow from operations using the direct method. Next, we want to look at the income statement. And the items we need to take a look at are our sales. Then we need to look at cost of goods sold to determine our expenses associated with the sales. And we have to look at salary expense, interest expense, and income tax. We ignore depreciation expense and loss on sale because we only take those into consideration when we're doing the indirect method. We also do not care about the transactions at the bottom because those are all investing and financing. Now we can do our cash flow from operations, direct method, first we're going to look at the cash receipts from customers. Again, what we're going to do is we're going to subtract out any increases, because that means we receive less cash than sales, and we're going to add on any decreases. So in our case, we had a beginning of 75, we ended up with 73, which means we collected an additional 2,000 in cash along with the 380,000. Now we're going to look at how much cash do we get from suppliers. Well, we are going to look at our inventory, do the 130 credit, which would have been an offset of the cost of goods sold. And then we know that we added 135,000, which is what we need in order to make it with an ending balance of 75. So you always want to check. The 70 plus the 130 gives you 200, minus 135 gives you the 175. I'm sorry, that gives you 205 minus the 130. Okay, then for accounts payable, we know that means we would have credited that amount, assuming all of our purchases are on account. We know our ending balance, which means that we must have paid out 142,000. So that's going to be the cash payments to suppliers. Then we have salaries payable. We need to go through and do that. We always start with our beginning and ending balances. We then add our salary expense to figure out how much of that was actual cash. And since our salaries payable went down by 3, it means we actually paid an extra 3,000. Interest expense, we start with our beginning and ending. We had 12 in interest expense, but it went up by 2, which means that our cash was only 10. And for taxes payable, we have it went down by 3 plus the 70, which means we had cash paid of 73. Now we can do our cash flow from operations. So there's our cash flow from operations. Now we're going to go through and do investing activities. Now we're going to look at this, and we're going to now go back and look at the transactions that are identified as investing activities. And we have 3 of those. We have an increase in short-term investments of 25. We have an increase of 105 with building and equipment, and we have a decrease in 10 for land. So now what we can do now we know what the change is. The next thing we need to do is look at the notes that we had that as part of what we showed for the income statement. So what we need to do is we need to look at this, and we know that the $10,000 change for the land less the $3,000 loss means we got cash of 7. Now, the 25,000 equals the increase in the investment account, so we're going to be able to use that. And the 150 increase for equipment equals what we said we'd use to buy new equipment, and we know that these are all transactions associated with investment activity. So we're going to identify that as investing, which means that now what we're going to do, we're going to be able to do the investing portion of our cash flow statement. And we've got the sale of the land, which means we would have received cash. Purchase of short-term investment means cash would have gone out the door, and purchase of equipment means cash would have gone out the door. So we have use of cash flows for investing activities. So we generated cash from operations, but we spent it on investing activities. Now we can do financing activities. So now what we're going to do is we're going to look at, now notes payable went down by 30, bonds payable went up by 60, common stock went up by 50, and additional paid in capital went up by 26. Now let's look at those changes that we identified at the bottom of the income statement. And we want to make sure that they concur with these changes that we're showing on the balance sheet. So we had a $30,000 note, which equals the $30,000 decrease in notes payable because we paid it off. We issued some bonds at face, which means bonds payable increased by 60, and that concurs. And common stock was sold for 76, which equals the $50,000 increase in common stock and $26,000 increase in additional paid-in capital. And dividends, that equaled our change. We want to make sure we've explained our change in retained earnings, which would have been net income of 80 minus dividends of 35. So now what we've got is we've got these four items that would be part of financing activities. So these now would be all part of our financing activity. So now we can do that last part of our balance sheet. Cash flow statement. So here we go, cash flow financing activity. We had the repayment of the note, the sale of the bonds, the sale of the common stock, and the payment of the dividends. Now we add all these together and we get our 12, which we said we had to have. We add it to our beginning cash, which equals our ending cash. Now you think we're done, but we're not, because now what we have to do is do the cash flow operations from using the indirect method. So now we're going to go back here, and again we are going to use all of those changes that we're showing for operating activities, but now we're also going to use the accumulated depreciation, which would equal our depreciation expense. So what we want to do is remember, if they're current assets and they go down, we have to add them in. If they go up, we have to subtract them out. Now for current liabilities, they go in the same direction. So for accounts payable, if it decreases, we subtract it. If it increases it, we add it. So now we can do, first of all, we want to look at that income statement, because the other thing we have to look for are any non-cash type of activity that would be included as part of net income. So when we look at this, we know that we have to take into consideration depreciation expense and that loss on sale of land. We need the net income and we need the depreciation and the loss on sale of land for our, we start again with net income, which would be 80. Then we include our non-cash type transactions, and then we would do our changes in our current assets. And again, since accounts receivable went down, that means we got $2,000 more cash than we had in sales. Our inventory increased, which means we have expenses that were non-cash as part of that net income, so we have to back it out. Now for our accounts payable, these are our current liabilities. We go in the same direction. So if it went down, we subtract. Again, salaries payable went down, we're going to subtract. And interest went up, so we're going to add that in. And then the last we have is our decrease in income taxes payable. We add all those up and we get our 109, which is exactly what we received using the direct method. Now, this ends my presentation on the cash flow statement. I hope it helps.